I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of April. On average, over the long term, April tends to be one of the better months of the year for the stock market. But we did see some signs in March that the stock market may stumble a little bit later on in April, or even start to transition into its weaker 6-month period of the year on a seasonal basis a little bit early. Before we get into that, though, let's take a look at the seasonal trends for the stock market and different sectors of the stock market at this time of the year. If we take a look at the Thackeray's 2022 Investors Guide here, and if we take a look at the S&P 500 from 1950 to 2021. This is the average performance in the month of April. Every year is different, of course, but this is the average. We can see here this upward trending line in the first half of April when the stock market tends to do well. That's largely because investors are trying to get ahead of the earnings season with companies releasing their earnings starting typically in mid-April. And if we take a look at the frequency of strong performance, of being positive, you can see here that in the first half of April, we have tall bars here, which represent a high frequency of positivity. Bars above this line here represent above 50% being positive on a trading day basis, and below means below 50%. So we can see here that a corroboration that we tend to find a lot of positive days for the stock market in the first half of the month as well. If we take a look at the sectors of the market here, and this is from 1990 to 2021, the sectors, and this is ranked according to the sector with the highest average gain in this time period in the month of April in a descending order. And the last column here represents the frequency of outperformance relative to the S&P 500 as well. So in April, out of the major sectors of the stock market, the energy sector has been the top performing sector in the month of April. And if we take a look at what's going on in the markets here, for the energy sector here, I'm using XLE, the ETF in the States. You can see here the strong performance starting at the beginning of 2022 and relative to the S&P 500 when this line's rising, it means outperforming. Here you can see towards late February this sharp acceleration relative to the overall market that was at the start of the unfortunate Russia-Ukraine war. We have seen a pullback here and it's starting to roll over a little bit. But the energy sector tends to perform well into the month, into early to mid-May and sometimes even into June. But we are coming to that time period where the energy sector can start to roll over relative to the market on a seasonal basis. There's a lot of fundamental factors going on here, and it could be different this year, but it's important to know what the overall seasonal trend is as well. If we take a look at what else is going on in the marketplace here, on a seasonal basis, the material sector tends to perform well in the month of April as well. Now, it's only got a 53% frequency of outperformance relative to the S&P 500, which means that there's been a few times where the material sector has actually performed quite well relative to the S&P 500, and it's pulled up its overall average and skewed the numbers a little bit. If we take a look at what's going on in the S&P, the material sector here. Now, it's important to know that the material sector is made up of 70% chemical companies in the States approximately. Here we are using XLB in the States. It's been an absolute, really here, consolidation phase taking place since May of 2021. More recently, though, we've seen outperformance of this sector relative to the S&P 500. Now, typically the sector tends to perform well from late January into early May, so we still have some time here, which is good at this point here as well. If we take a look at the next one down the list is the consumer discretionary sector, which tends to perform well in March and April. We have seen that a strong performance in March as well. And if we take a look here, we can see here that in March, we did see that initial downtick, and then we've seen strong performance. And relative to the S&P 500, it's actually moved higher. We're using XLY in the States for the consumer discretionary sector. Now, this sector does have a large percentage of Tesla and Amazon in there, so we can see it move because of the movement in those securities having an influence there as well. But in April, we do see that the consumer discretionary sector tends to be positive again. But I do want to put a caveat on this. It's about mid-month. It usually tends to perform well into about mid-month. And then the preferred sector tends to be the consumer staples stock, which is the defensive sector as well. So it's just something to watch out for as well. If we take a look at what's going on here, In the next sector down, we'll take a look at is the financial sector. In that sector here, the strong performance really comes in the first half of the month, and then it tends to be weaker a little bit. So that is definitely something to watch out for. Although on average it's been one of the top performing sectors, it really is skewed towards the beginning of the month on a seasonal basis. And if we take a look at XLF in the US, here we can see this just consolidation period really from May once again into May 2021 into 2022. And here we can see this relative to the S&P 500. We've seen this consolidation, but look at this underperformance relative to the S&P 500 since late February. And that's even though interest rates have been going up. So this is the 10-year yield. We've seen the 10-year yield going up. That hasn't really helped the financial sector. Usually that helps the financial sector, but it's not just interest rates rising, it's also how flat the yield curve is. And this bottom panel represents the 10-year yield minus 2-year yield in the States. And you can see here that it's getting flatter and flatter. In fact, today when we're filming this, it's actually negative 0.06, which is often a sign of an impending recession, but not right away. It might be 6 months or a year ahead as well. I have written about this in the past, and it's been in the media a little bit, but it does indicate that softness economically could be coming up for the overall market as well. Earlier I said that there were some warning signs in March that could indicate that we might see the stock market stumble a little bit in the month of April, perhaps later on, or even head into its weaker 6-month period a little bit early this year, which usually starts in May, and obviously can start later than that as well. But I wanted to take a look at this graph here, and this is, I think, an important graph to take a look at. And let me just explain. This top panel is the S&P 500. This next panel down here is the defensive sectors of the market. So in this case here, the black is the healthcare sector, the red is the utility sector, and the green is the consumer staple sector, and the brown is the real estate sector in the States. Now, I do want to point out something before we talk about March and April here. I want to go back to 2021, December. So in December, we saw a rising stock market. Sure, there's some volatility along the way, but look what happened. We saw the defensive sectors. Now, when these lines are rising, that means those sectors are outperforming the S&P 500. So what we saw was a rising S&P 500, and we saw the defensive sectors outperforming the S&P 500. And this bottom panel I want to point out is the yield on the 10-year Treasury note as well. And at the same time, we saw a flat to rising yield on the 10-year Treasury note. So what was going on? Why were investors moving into the defensive sectors? That was an indication that they were becoming a little bit concerned with the market valuation. Now, we saw a strong stock market in 2021, and investors were starting to position themselves accordingly. So that was a warning. And then what we saw at the beginning of the year for 2022, we did see the S&P 500 pull back down here. And in this case, we saw the defensive sectors from here. It's interesting. They didn't outperform in this initial time period here. They sort of flatlined, and largely due because they had run up already here. And it's only when the S&P 500 really started to decelerate right in this area here that we saw the performance actually start outperformance of the defensive sectors again. And I wanted to point this out because let's take a look and show we've seen the defensive sectors actually outperform again here in February into March. Now you can say, well, look, we've seen the stock market going down here, so that can happen, and that is true. Investors do come over to some of the defensive sectors, but let's take a look at March. I want to take a look here. What we saw was even in about the 22nd of March, the S&P 500 was moving up here, and the yield on the 10-year Treasury note was moving up, and we start to see, in this case, the utility sector start to turn higher. The other ones did. They waited a little bit longer, but then what we saw towards the end of March, we saw all of the defensive sectors in the last week actually outperform the S&P 500. The S&P 500 did pull back down sharply, and we did see a pull down in the yield, which would help the defensive sectors. But when we're seeing the defensive sectors outperforming the S&P 500, this can be a warning that investors are starting to position themselves more defensively. Now, in this case, back in December, this is a big warning because we saw rising yields all at the same time and a rising stock market, and yet defensives were actually outperforming. We haven't seen that quite yet, but the defensive sectors are something to watch out for in the market, trying to gather this sentiment as well. If we take a look at the overall market, we're still in that strong 6-month period for the stock market here. And the first half of the month tends to be positive as well. So it's still a good time from a seasonal basis, but it's something we need to watch out for. And earlier I talked about the consumer discretionary sector performing well on a seasonal basis in the first half of April. And then the consumer staple sector in the second half of the month tends to be the outperformer. We might see something similar for the defensive sectors this month. So we might see that transition take place a little bit later in the month. And a lot might have to do with the earnings season coming up as well. Once we kick off into that earnings season, if investors start to become a little bit defensive, we could start to see them roll into not just the consumer staple sector, which on a seasonal basis tends to be the time, but we might see investors start to roll into some of the other defensive sectors as well. Now, when the defensive sectors are outperforming and the market's actually doing quite well, it typically means that there's not huge gains to be made in the market when the defensive sectors are outperforming. It's because investors are just overall too concerned with what's going on. So something to watch out for. We're still in a strong 6-month period. We're still seeing this bounce in the S&P 500. We're above the critical line on a technical basis for the S&P 500, above 4,300. So the market still has some things going for it. Of course, there's this really unfortunate Russia-Ukraine war, and you can never predict what's going to happen in these war situations, and that can cause huge issues to the economy and how the government's going to react, et cetera, et cetera. So we don't know those factors. So that can change things dramatically as well. But I do want to point out here, we're almost we're a month away really from the time when the stock market tends to start to weaken. In other words, it moves into its weaker 6-month period for the stock market on an average basis over the long term. Now, it doesn't mean that's going to be there's going to be a big, huge correction in that time period. It just means that it tends to be weaker, then the rewards aren't as strong. And if there is going to be a correction, it tends to happen more often in that time period. So we're a month away from that. We could see the stock market still perform well here, but it's something we need to watch out for, that we could be transitioning into that a little bit early, perhaps even around once we start to get into that halfway point for the month of April. Thank you very much for joining me today.